This article came out today and it says 11 out of 16 analysts rate Plains Holdings as a buy. Do you think Plains Holdings is a buy? Let's analyze the stock. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I'm going to walk you through the process of valuing Plains Holdings stock by analyzing their financial ratios and dissecting their financial statements so we can determine if the stock is a buy or a sell. Plains is a holdings company for Plains All American Pipeline. Plains All American Pipeline is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. A holding company is a parent company that owns enough voting stock in another company that it can control that company's policies and oversee its management decisions. It owns the assets of other companies but doesn't actively participate in the day-to-day operations. This holding company only holds one company's stock, Plains All American Pipeline, but you have holding companies like Berkshire Hathaway that own many companies' stock. So you can invest in the holding company or in the subsidiary. In Plains' situation, it really wouldn't matter if you invested in Plains Holdings or Plains All American. Let's get started with the model. This is a small cap company, 1.2 billion market cap, and they're trading at $6.68 a share. And to get shares outstanding, it's market cap divided by stock price gives you shares outstanding 184 million. Free cash flow, that's how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are property, plant, and equipment. And if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. And this company has positive free cash flow in 3 of the 4 years. We'll look at the financial statements later to see why they had that negative. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they had positive net income in 3 of the 4 years. They had a negative in 2017. We'll look at their income statement later to figure that out. And their revenue grows quite a bit. It went from 20 billion to 33 billion. The revenue did drop in 2019, similar to other midstream companies. And their margins are pretty low, 0% to 6%. So they don't convert that much revenue into net income. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. So 6% of that revenue was converted into profit in 2019. That means 94% went towards expenses. Let's look at the financial statements. The financials for the holding company in this case are identical to the subsidiary because this holding company only owns one company. But if this holding company owned multiple companies, you would see all the financials grouped together. In 2016, they had negative free cash flow, but they had positive in the other years. Free cash flow is operating cash flow. That's cash flow from your operational business minus capital expenditures. Capital expenditures are investments in property, plant, and equipment. So their CapEx is pretty similar year to year. So it's not a big CapEx year in 2016. They had a really low operating cash flow amount in 2016, about 1/3 of the other years. The way you calculate operating cash flow, you start with net income. It was $660 million. Then you adjust for the non-cash items on the income statement. So you add back depreciation since you had to subtract that from the income statement. Then there's smaller non-cash items you have to adjust for. There's also changes in working capital. So you can see their net income was a lot lower in 2016 when compared to 2018 and 2019. But it was a lot higher than 2017, and in 2017 they had positive free cash flow. There's lots of things going on in the cash flow from operations section, but the one thing that jumped out in 2016 was a change in working capital, negative 487 million. So this company reported negative 524 million in receivables and negative 463 million in changes in inventory. So this really brought down their free cash flow in 2016. When a company uses accounts receivable, it is shipping a product to a customer but not receiving payment, so it's selling on credit. Accounts receivable negatively affects cash flow. In 2016, they had negative $524 million. In 2018, they received a cash inflow of $309 million from accounts receivable, and I expect more so in future years. Similar with inventory, when a company buys inventory, that also negatively affects cash flow. Many companies have gone out of business due to poor inventory management. So buying inventory is obviously important for the business, but you have to offload it to the customer. And if you don't, if it just sits on your balance sheet, it sits in your warehouse, it doesn't do much good for you. So it looks like they had a positive cash inflow in 2017 of $600 million for inventory. But in 2016, it was a negative because it just sat in their balance sheet. In 2017, the company had negative $41 million of net income, and we'll look at the income statement to figure that out, but they had positive free cash flow. A big reason was this deferred tax of over $900 million. Deferred taxes are taxes a company will eventually pay, but are not due yet. Deferred taxes come about due to the differences in tax recognition between the IRS and the company's accounting methods. Companies are required to use GAAP accounting, generally accepted accounting principles. So when the company does pay these taxes, it will be a cash negative. The government gives a lot of flexibility to oil and gas companies to defer taxes because they provide a product that's really needed. Other companies don't get as much flexibility as oil and gas companies do. This is the income statement. The top line is revenue, the sales. Below that is cost of revenue. In 2017, they had $2.6 billion of gross profit, which was more than 2016. Below that is operating expense, then below that is operating income. So they were operating profitably. That's what you want to make sure when you invest in a company, that they're operating profitably. Below that is the interest they pay in their debt, which was less than 1/2 of their operating income. So that looks okay. Below that is other, which is money the company generates or loses outside of its normal operations, and that was positive. So in 2016, they had $896 million of pre-tax income. But according to their income statement, they paid $937 million in taxes. But this is a non-cash item because it was reversed out on the statement of cash flows. So that's why they reported negative $41 million of net income. Like I said in prior videos, don't look at net income. That's not a good indicator of a company's health. Always look at cash flow from operations. That's a better indicator. So you can see in our operating business, they generated $2.5 billion. The income statement is still important, but you just need to understand all these things. It's like a big puzzle trying to link things together. Let's look at a capital structure. $10 billion of debt, $15 billion of equity. They pay 4.39% interest on their debt, and cost of debt is 4.04%, which is interest rate times 1 minus the effective tax rate. And 40% of the capital structure is debt, which means 60% is equity. Cost of equity is 18.52%. We calculate cost of equity using the capital asset pricing model. Part of the CAPM formula is the beta. The beta is how volatile the stock is relative to the market. So it's a pretty volatile stock, 2.11 beta. That means the stock moves more than 2 times the market. The higher the beta, the higher the cost of equity, and the higher the volatility of the stock. And their WACC is 12.72%, which is a blend of the cost of debt and cost of equity. And the WACC is a discount rate we're going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $4.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.8 billion. We divide that by 184 million shares. And we get a calculated stock price of $31.37. They're trading at $6.68, so they're trading at a 79% discount. It's a really strong buy according to the model. Simply Wall Street is even higher than me. They're at $37.76. Simply Wall Street's valuation is based off of the average analyst estimate. Let's see where the stock has been trading the past few years. The stock had a 3-for-1 reverse stock split in 2016, so the stock price wasn't this high in the past. It just looks this high on this chart, but it was actually 1/3 of this price. But like most oil and gas midstream stocks, the stock has come down quite a bit. It looks like an amazing value from my model and Simply Wall Street though. So it looks like the company keeps cutting its dividend. It was 62 cents, then 55 cents, and 30 cents. It did increase to 36 cents, but they cut it in half this year to 18 cents. So they're really trying to conserve cash. They do pay a pretty good dividend yield, 10.65%. And the dividend yield is the annual dividend payment over stock price. So as the stock price comes down, the dividend yield goes up. So a lot of these midstream companies have such high yields because their stock price was cut in half or cut in a third. It's good to understand that a company's financial performance doesn't always move their stock price in the right direction. A company can be reporting really good numbers and their stock price goes down. Another company could be reporting really weak numbers and their stock price keeps going up because the market is forward thinking. It looks towards the future, not the past. The only indicator of stock price is supply and demand of the market. If there are more buyers of stock than sellers, the stock price will go up. And if there are more sellers of stock than buyers, the stock price will go down. The reason I focus on the financials is because all the information is there. There's nothing to hide. But if you listen to others, then they could spin the stories to make the company sound really good or really bad. Always do your own due diligence. If you invest in companies with good fundamentals and hold the stock long term, you should be better off than most investors. Let's look at their financial ratios. Their price multiples are extremely low. They're a holding company, so you have to take that into consideration. The median PE for the market's 15.7, the average is 17.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 0.6, so investors are paying 60 cents for $1 of earnings. The median price to sales is 2.0, the average is 4.6. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. Their ratio is 0.04, so investors are paying 4 cents for $1 of revenue. The median price to book is 2.3, the average is 4.8. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 0.1, so investors are paying 10 cents for $1 book value. Equity is total assets minus total liabilities on the balance sheet. They have a good interest coverage ratio. The median for the market is 4.0, the average is 12.8. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. EBIT is earnings before interest and taxes. It's on the income statement called operating income. The ROE is around average. The median is 12%, the average is 13%. ROE is net income over equity, and they're at 14%. Current ratio is a little low. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities, so they can almost cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables that are due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios is to compare them to similar companies. I've done videos on 38 oil and gas midstream companies, and Plains Holdings is right here. If they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they do have the best price to earnings, price to sales, and price to book of all the companies on the list. Their current ratio is a little low. They're better in ROE. They're lower in debt. They're a small company, 1.2 billion market cap. Plains, the operational arm of the business, is 5.7 billion market cap. Their dividend is 10.65%, which is lower than average of 12.08%. So to summarize, I have them trading at a really deep discount. Their ratios and financials look pretty good. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, get a custom valuation, or just support the channel, you can become a member by clicking on the link in the description below. Every month, I will provide my members with an Excel file to help them better analyze companies. Thanks for watching.